Donating your money or time to companies, individuals, and organizations you believe in is a more effective way to make a difference than a corporate stock boycott. Hi, I'm AJ Ayres, and I write the Substack Money Changes Everything. Is it possible to invest ethically? Key takeaways. Believing that you have to choose between growing wealth and having values is not only a false choice, it's an expensive one. Growing your wealth and using it to support causes you believe in and your local economy and community is the best way to ethically invest. Giving money to a corporation you view as problematic every once in a while for their speed and convenience isn't a moral sin. Ethical investing often serves more as a form of virtue signaling than as a mechanism for actual change. It feels good, it sounds good, it gives you the sense that you're doing something, but feeling aligned and making an impact are not the same thing. Socially responsible investing has gotten more sophisticated over the years. Known by many names like ESG, impact investing, mission-driven investing, what we're talking about is deliberately excluding companies from your investment strategy that have reportedly done something you don't like or don't align with your values or dreams for a better future. Today, you can build custom portfolios that can exclude gun manufacturers, fossil fuels, private prisons, or whatever else you want removed. If you tell your financial advisor you don't want to own gun companies, that is absolutely doable. For most people, ethical investing is a costly illusion that substitutes moral comfort for real impact, and the price is slower wealth building that actually limits your ability to do good. And to be clear, I care deeply about this issue. Guns are the #1 cause of death for children in this country, surpassing car accidents and cancer. Wanting to reduce gun violence is not up for debate here. The question is whether your investment portfolio is an effective way to act on it. The problem with ethical rubrics. So-called socially responsible portfolios are built on arbitrary scoring systems, not moral clarity. Take a widely marketed ESG fund like the Vanguard ESG Stock US ETF, ESGV. On the surface, it sounds exactly like what a values-driven investor would want. It excludes stocks of companies that do not meet certain labor, human rights, environmental, and anti-corruption standards. The bone I have to pick is with the word certain. A better word might be arbitrary, because when you look at the methodology, it's hard to follow, and frankly, it's disappointing. ESGV doesn't ask, is this company good? It asks, is this company slightly better than its peers on a specific set of metrics? The fund tracks an index that excludes companies involved in certain activities like weapons, tobacco, or thermal coal, includes massive corporations with documented labor violations, environmental damage, or political lobbying, so long as they score relatively well to competitors. It weights companies based on disclosure quality and policies, not outcomes. In other words, a company isn't rewarded for doing less harm, it's rewarded for checking the right boxes. A fossil fuel company with a polished sustainability reporting score can score higher than a small industrial firm that lacks the resources to play the ESG ratings game. A tech company can rank well on governance while fueling surveillance, data exploitation, or union busting, because those things don't always show up clearly in a rubric. This is how you end up with portfolios labeled green or ethical that still hold many companies investors would find deeply objectionable if they look past the label. JPMorgan Chase versus Wells Fargo. Let's dig into it. What gets labeled good enough to go in an index that is marketed to people concerned with bad-acting corporations is messy and frustratingly opaque. In ESG frameworks used by funds like that Vanguard ETF, JPMorgan Chase has historically been included, while Wells Fargo has often been excluded or underweighted following its governance scandals. The two companies are large banks, identical in many ways. Both have financed fossil fuel projects, both have paid billions in fines to compensate for various scandals and misconduct, and both are systematically important institutions. However, in the world of socially responsible ESG investing, these companies are treated differently because Wells Fargo's fake account scandal triggered governance red flags, and the ESG scoring systems penalize recent visible scandals. JPMorgan avoided a single headline-grabbing governance failure of the same kind, until now. There was a recent New York Times investigation that uncovered years of JPMorgan ignoring red flags in Jeffrey Epstein's bank accounts related to human trafficking. If you invested your money in an ESG fund to avoid bad actors, it would not make you feel good to know you have been investing in this company. What might happen is that you move your money out of that fund entirely. Maybe you sell it, you trigger taxes, and potentially you don't invest in the stock market at all for months or years until you feel comfortable again. That's why this is so devastating to the ESG narrative. What's being rewarded here is reputational management as well as timing. A bank that commits fraud badly and publicly gets kicked out. A bank that does controversial things successfully, consistently, quietly, and at scale stays in business. Once you see that, it becomes much harder to believe that investing as a small shareholder is a meaningful form of activism. The impact of divesting is a rounding error. Let's say I have $1 million investment portfolio, and I decide that the only way I will feel comfortable investing is if none of my money is invested in gun manufacturers or automatic weapons suppliers. So I do my own research, and I decide that the 5 public companies listed below are ones that I want absolutely nothing to do with. These are just 5 that I picked. There are absolutely plenty more companies that you could argue aid in the proliferation and manufacturing and distributing of guns. But what about Walmart? Walmart sells guns, but Walmart also provides jobs and healthcare to thousands of Americans living below the poverty line. Let's not throw the babies out with the proverbial bathwater. So I've got a list here of 5 companies and their weight in the S&P 500. So we've got General Dynamics, we've got the RTX Corporation, which is Raytheon, we've got Lockheed Martin, we've got Smith & Wesson, we've got Sturm, Ruger and Company. And so with modern trading technology, it's easy to exclude these companies from your portfolio. Even if we add up the approximate weight of these 5 large public weapons contractors, they collectively make up less than 1% of the S&P 500. So if you put $1 million into an S&P 500 index fund, roughly 10,000 of it would be allocated to direct weapons manufacturers. Or you could invest in a fund that markets itself as excluding weapons altogether, like the Ariel Fund. Are these companies going to miss your $10,000? No. Is your divestment going to affect their access to capital? No. Is it going to change their behavior? Also, no. This is the core mismatch in ethical investing at an individual scale. The emotional weight of the decision far exceeds its economic impact. The strongest counter argument to my argument here is that ethical investing isn't really about divestment. It's about engagement. Proxy voting, shareholder resolutions, influencing corporate behavior from the inside. In theory, that's compelling. In practice, for individual investors using off-the-shelf ESG funds, that influence is indirect, diluted, and largely symbolic. You are not directing the engagement strategy. You are outsourcing it to index providers and asset managers whose incentives are to track benchmarks, minimize tracking error, and avoid controversy, not to take principled standards that meaningfully jeopardize returns. For every dollar I choose to divest from gun companies, someone on the opposite end of the political spectrum is investing that same dollar to make the opposite point. So don't spend time hand-wringing about divestment if you're a small investor. And by small, I mean under $10 million. The opportunity cost we don't like to talk about. Ethical investing does provide a benefit. It just isn't a public one. It makes the investor feel good. It offers a sense of moral cleanliness and personal alignment. You get to look at your portfolio and feel like it reflects your values. There's nothing wrong with that, but we should be honest about what's happening. The primary beneficiary of ethical investing, at least at this scale, is the person holding the portfolio. The personal satisfaction is real. The impact largely is not. That doesn't make people's desire to invest ethically wrong, and it doesn't make giving to causes you care about futile. But if the primary goal is emotional relief, you'll give in ways that feel soothing instead of ways that are effective. Pure generosity is quieter, more disciplined, and much less interested in how it makes you look or feel. What I recommend to clients who want to invest ethically, particularly those concerned about exposure to industries like weapons manufacturing, is to separate investment from impact. I encourage them to invest for long-term growth and make a direct impact by donating to organizations that are doing meaningful work. I'm a pragmatist, and as a financial planner, I want to see tangible, measurable results. My main concern with ethical investing is that its methodology is wishy-washy and its impact is difficult to verify. Too often,